it's time to move on. First of all, we always start the show asking our guest, Chase, in this case, to tell us about what's on your mind and what's the most pressing thing or the important thing that you're watching. And so, first of all, Chase, if anyone wants to follow you, they can follow you at Pinecone Macro on Twitter, right?
Absolutely.
Yeah. So, and you write a great blog. We'll talk or letter. We'll talk about that a little bit later on. But what is on your mind? What did you want to talk about?
So I kind of noticed this week that, first of all, I was a giant bond bear, kind of like Kev there for a while, for really about 2 years, and I flipped last fall. The biggest reason I flipped was because oil just respected none of my squiggles and just cut through it like hot butter and stopped me out on the way down. And between that and stocks just cratering, I kind of realized something was different in the economy. So that's when I started thinking we're going to see some deflation and bond yields get lower, and got long bonds. And actually, about a week and a half, 2 weeks ago, I got out of those long bond trades. They kind of just hit some technical levels that looked like we get a bounce, and now we are getting a bounce, maybe even kind of bigger than I expected. So, and on the same exact things happening, but opposite, where stocks and oil have flown through levels that I thought would slow them down at least.
Yeah,
So
that's been crazy. Like just unbelievable V shape on that oil chart. Just yeah, when I listen to Art Berman and others talking about the structural shift in the oil market, suddenly oil's like a stone's throw away from the ranges it collapsed from. It's unbelievable.
yeah, oil kind of is right around that 61.8 retrace right now, but you actually look at gasoline futures and they're well ahead of, they're near the actual where they started.
Yeah,
So,
yeah.
so that just got me looking, okay, like maybe we're going to start seeing some inflation again. So I just kind of started digging around and did find some areas. And one of the things I looked at was, as you have up here now, the 30-year yield. As I think we all know, we broke out of the downtrend line that's been going on since about the time I was born. But since yields have collapsed back down, they've actually tested the top of that trend line and are now bouncing higher. So I just found that pretty interesting. If you go on to the next slide there, I'll kind of talk about it. German bond yields are kind of popping higher, especially this week. And the data that came out of China was showing, most of their data is kind of picking up a little bit. M1 finally looks like it's bottoming and trying to get off the floor. So the fact that bond yields are kind of following some of that Chinese data, so just starting to look like the whole world is seeing a little bit of reflation. And I don't think China's going to do what they did a few years ago. I don't think it's going to be a giant stimulus that pumps everything again, but I do think it might be enough to kind of keep inflation a little higher than folks expect, especially in the U.S. with where labor markets are.
Well, there's no denying in my mind that inflation has just picked up a little bit. But do you believe that this is just a short term kind of a counter reaction to an overshoot, or do you believe that this could develop into a bigger trend where inflation comes back with a little bit more muscle?
I think kind of in between. I don't think we're going to get some big spike or anything. I still think the economy is going to keep weakening into the second half, so it's going to make it kind of tough. I just think it's going to stay higher than people expect, mostly for the rest of the year. Nothing crazy, but enough to throw people off.
Right.
So I thought for a second there, Chase, you were going to be completely in my camp, and you were going to tell Patrick that all his deflationary nonsense was exactly that, and nonsense.
That just means that he's a smart guy.
Yeah. So I think it's just you guys hedging your bets. So you don't want to come out and just say it's headed lower.
I actually think it's headed lower. But
you think that you're trying to be respectful of our guest? I take it. One of the things that I just want to kind of point out is that as we go throughout the year, and you look at the year over year, energy is the biggest kind of input into inflation. And as we approach the latter half of this year, we're going to be comparing against points of inflation, of crude oil prices that were $45, $50. And so I completely agree with you, Chase, that we're going to be surprised at the fact that come later in the second half and especially in that last quarter, if all that has to happen is crude oil has to not go down, and the amount of pickup in CPI is going to be huge. It's going to catch everyone off guard.
Yeah,
And
absolutely.
sorry, go ahead.
No, I was
No,
just
you
going
go
to
ahead.
say a couple charts forward. I have a chart of gasoline futures, and it's a monthly, and then I kind of superimposed the CPI on it. It's definitely chart crime because they don't match up perfect, but it does still show you like kind of where we've been with CPI and gasoline, and the fact that gasoline is now just ripped higher, and I think it will be a big input in pulling inflation higher in the months to come.
And so I have a question for you. You know, we've seen a big shift from Powell. There's no doubt that he flip-flopped. And the question I have for you is, do you think that it was a mistake in raising rates to the point where he did, and he caused the economy to stutter to a point where we can't pull out of it? Or do you think the mistake is now in that he's allowing kind of rates to go back down and he's not continuing with that hiking path?
I think it's fair to say December was a mistake. It's at that point, oil and stocks are both falling off a cliff, and a lot of leading indicators were looking terrible. And not only did he, hike in December, but he did it, really strongly, and said, I always say he told us we could take QT from his cold dead hands that day. And then, well, I guess his hands are pretty cold
Charlton
now. But,
Heston, right? Yeah, right.
Yeah. So I think how forceful he was in December, and the fact that he did hike in December, that may have been a mistake. And I know a lot of people have been, upset with the reaction since and the fact that he's capitulated. But I think, to be fair to him, like all the data is pretty much, supported the Fed, going easy since. So I'd say December was a mistake. What he's done since might be a mistake in the long run from the, standpoint that financial stability could become an issue again, something that he at least pretended to care about for a long time. And the Fed did talk about it this week, so it might be back on their radar, and maybe that's why we're kind of seeing a Fed caller instead of a Fed put up here. But
is anybody going to believe him if he comes out and tries to talk the market down? I think that they're just going to laugh at him. I think that he's lost all credibility, and that ultimately if he tries to go and if he gets worried about financial conditions being too loose, that he has become impotent for actually tamping those down.
Yeah. When you add to the fact they're talking about symmetrical inflation now, if we do see inflation stay higher than a lot of us or a lot of people, market participants, think in the months ahead, that's kind of he's going to get put to the test big time. And I think you're right. I think if he starts talking tough, people, I don't think hikes are going to get priced in no matter how hard they try, at least early on.
That's right. So now I saw in one of your charts that how would you play this? So if we expect an uptick of inflation and you see that we're going to second half that this is going to occur, what would you do? Like, how do you position yourself? How do you take advantage of it?
So because I do think the economy is going to keep weakening, but inflation could be a little stubborn, I think tips are something that are a solid option. And the tip ETF, it has been doing well lately and is actually kind of hitting its head on a downtrend line, a horizontal area of resistance, and it's like right at the 200 week. So there's three kind of clustered areas that are important technically that it could break out of here shortly. So if it does break out of that, then that tells me, I may be right about we're going to slow, but we're going to see inflation, be stickier than everyone thinks. And then I think tips could be a good place to hide for a few months. And
okay, and then what?
Also, if you look
you
at
have
tips
another
versus,
one. That's right.
Yeah.
You have the RINF, right?
Yeah, and that's another one you could use. And the inflation expectations ETF, which you've talked about before, it's kind of scary because it kind of looks like it could be a bear flag, but again, it's worth watching, and it's something that's similar to tips where if inflation expectations do go higher, then that ETF will perform well, but you're going to get the same action in tips because they kind of move on inflation expectations. So, and when you chart,
that's
I'm going to pine in here because to me, I completely understand the argument that energy is the biggest input into inflation expectations. And when we have this magnitude of a rise in gasoline and oil prices, that it has to result in some sort of an uptick in inflation numbers, right? And so we're going to see. I think we just had a hot PPI number print, and it's certainly going to cause some cost push inflation to come in, but through history on a much bigger scale, in order for there to be a sustained rise in inflation, you need to make the argument that there's going to be some material increase in money supply, and that somehow, either whether through a credit surge or through some money thing, and so while yes, there's no denying that there will be higher short-term inflation, but to me, and you guys can rip into me all you want on this, but until I see someone make me an argument that we're about to see a big surge in money creation that could drive sustained inflation, then this is just going to be faded. I think this is just an opportunity that if they create a pop in this inflation expectations because of the short-term little surge, I'll be shorting that all day long.
Chase, you go ahead. You tell Patrick why he's wrong.
Yeah, well, I mean, you guys have talked about MMT a lot, and I think we all kind of see that as an inevitability. So, of course, if you're looking for something to really anchor those inflation expectations higher, I think.
Okay, but that's pretty big picture. The MMT is not coming in later this year. So if we're going at 3 to 5 years and past the next presidential cycles and all that stuff, then maybe. But I mean, what are the drivers this year and next year that could drive sustained inflation other than this short-term uptick in commodities, which is definitely going to happen?
Yeah, I mean, we just saw Nancy Pelosi talking about $2 trillion infrastructure. So I think that could end up being a catalyst if, and I know there's a lot of debate about
that's catalyst for economic activity, but not necessarily, that may not necessarily result in inflation. But anyway.
Patrick, 1 second. No, Patrick.
Oh, my God.
Sorry, go ahead, Chase. I'll let you go ahead. Chase, you rip into him. Go, bud.
No, I was just going to say, I mean, if the economy is going to weaken and we get an infrastructure bill into a weakening economy, I wouldn't doubt at all the Fed, back that up by doing some more QE. Even if they don't lower rates much, I could see them doing new QE.
Okay. And not only that, Patrick, we're going to go into a $2 trillion infrastructure with unemployment employment as tight as it's been in ages. I think that.
Oh my God! Are you suddenly after wage inflation has not appeared here in years? Suddenly you're going back into this whole thing that we're about to have a surge in wage inflation. Is that what you're trying to imply?
We'll pick this another time when we don't have a guest that actually wants to talk about this. But I think the other thing that you should realize is that Brent Johnson from Santiago Capital has a great chart where he goes through and shows how the fiscal stimulus that everybody thinks petered out in 2018 is actually still alive and well and it hit its peak point, I believe, kind of mid-2019, not 2018. Now, there's some debate about how that's measured and everything like that, but we're still in a period where the Federal Reserve has taken its foot off the brake and the fiscal side is still pedal to the metal. So you're sitting around and you're looking at prices of oil going up, gasoline going up, and saying, oh, no, you guys are wrong. These are all about to go lower. There's no inflation. And meanwhile, I think it's happening all around you.
But it's not. If you look at the long
let Chase talk.
All right.
Let's let Chase talk.
So Chase, what chart do you want to go to next year? What's
there's a chart in there that kind of has 4 different charts showing some inflation data. You can pull that up.
Yeah.
And one thing I will say about what you guys were just saying, that wage inflation isn't here, but I feel like if 5-6 years ago you said, wage inflation was going to be over 3 and unemployment was going to be where it is, you would have thought of that as pretty inflationary. So it's not 0, that's for sure. For sure. So this just has some different research from. So one thing, the UIG that the New York Fed uses, if you look at the chart there, it is it has stayed way higher than CPI. CPI is kind of cyclically falling apart, but especially the full data set measure that the New York Fed uses is still stayed pretty high. It's around 3%. The Atlanta
Chase,
Fed
why don't
does
you explain to our listeners what UIG is?
So UIG is just something is for underlying inflation gauge. So the New York Fed creates it by sort of broadening out everything that they're measuring, so that it doesn't, it's not as quite as narrowly focused as other inflation measures that are typically used. And a lot of folks in the Fed prefer using UIG to regular CPI. So I don't think it's insignificant.
That's right. And I believe it's less jumpy, right? It doesn't move up and down as much, right?
Well, you can see that on the chart.
Definitely.
That it's far more stable.
They chart it against CPI where it doesn't move as much. And hey, maybe it is about to follow CPI down, but I think it's significant that it has stayed near its highs. And another thing is, like we talked about energy, but healthcare, housing have all been driving a good bit of inflation as well, especially the rent prices. And I know Goldman Sachs is showing where they think that this keeps marching higher, that and healthcare. So it's not just energy that just makes the base effects kind of pop.
Right. So I have to ask you though, going back one slide here, just on the Aussie, what's your thinking here on the Aussie dollar? Because I know one person that happens to be very bearish the Aussie, particularly against the CAD, and so what do you see here with the Aussie that's on your mind?
So I put it in here just because if you think you're going to get inflation, especially globally, you would expect the Aussie to start doing well, and it's kind of popped recently, especially with this week with the Chinese data. I've been an Aussie bear for a long time, really big bear, and I'm kind of in Kev's.
It's too much tourist on your mind, but
it is breaking out of its little downtrend. But I think I have a horizontal kind of line drawn that's not much further, and if we get above that, then I'm just wrong for a little bit at least. So I'm still overall bearish the Aussie, but I'm taking seriously the fact that it's showing me that the reflation out of China could start moving markets.
Yeah, actually, I'm in the camp as well, so I don't want to kind of try to play the other side here. But I'm like you. At least I'm an impression. I'm like you because I'm much more interested in the Aussie against the U.S. dollar versus Kev's much more of the Aussie CAD kind of guy. But I personally think that even if there is a short-term pop, that there just isn't the backdrop for a sustained rally in the Aussie. I think this is just a gift to go short again.
I agree.
Yeah. Kev, you have any opinion on that?
Well, I'm kind of torn on that one. I'll just go back to I like it against CAD. So I hate it against CAD because that's my trade on that. And a lot of the times the short-term squiggles, as you get news out of China moving it one way or another, it affects it. But longer term, I think the Australian dollar is going to, the Australian economy is going to underperform Canada's. And I go back to the fact that who's their biggest trading partner is China. I think China is going to underperform the U.S. Who's Canada's biggest trading partner is the U.S. Now, Chase, I noticed that you had a chart of the TIPS versus the TLT. Why don't you tell us what's on your mind there? And in some extent, isn't that just the RINF? Isn't that what we're looking at when you're pulling that up? Meaning that when you're looking at one versus the other, it is in essence just the inflation expectations.
Basically, that's what you're getting out of it. I just wanted to show it, because I think a lot of people with the economy slowing down just want to go hide in treasuries, and that makes sense. And it's probably it's been a great trade for a few months. It'll probably continue to be as data continues to weaken, likely. But if maybe a way to get a little extra juice out of being in bonds to go to TIPS, and it's kind of been building a big rectangle, and it's near the bottom of it and just poking ahead of the 200-week moving average. So I just thought, if you're going to hide in treasuries, maybe TIPS is a place to do it if you agree that inflation is going to kind of stay pesky for the next few months.
Yeah, so you have a definitely interesting call in that you think the economy is slowing, yet inflation is rising, which is kind of, very unique in that most people would say, yes, inflation's about to take off, but so is the economy, so you can expect rates to go higher. So I would take it that's why. And if you were let's just kind of break it down. If you were expecting that, you should own RINF. And if you're expecting your scenario where you have the economy going lower and like less economic activity and rates kind of drifting lower with it, yet inflation expectations going higher, you should expect TIPS to outperform the treasuries. Is that correct?
Exactly. That's exactly my thinking.
Yeah.
Yeah.
So that is definitely kind of an unusual call because usually with the higher economic activity, you expect kind of higher rates. Yet you're arguing that we're going to get lower rates at the same time with more inflation.
Yeah, and I feel like energy has been kind of unique in this cycle, and I think it's sort of offset from what you normally see. Most cycles end with oil near $100, and we're nowhere near that right now. So I could see it getting back up there before the cycle really has to take a turn. And so, but the rest of the economy is kind of struggling as the sugar high of tax cuts wear off. So to me, it's easy to see the possibility of slowing overall, but having inflation stay kind of hot especially because of energy.
And what would be interesting about that is that would mean real rates would go significantly lower. And that's in essence what you're arguing. And I've always said that the real problem with Powell's policies, that if you looked at like the 2-year tip yield, and let me just pull it up here on my charts, it had gone from it had been in a huge range for the longest time, and let me just pull it up here 1 second. U.S. tip 2%. So if you look at 2-year tip yields, we had been in a range basically from 50 basis points to negative 200 basis points, meaning that was the real yield. And once Powell came, he pushed those yields out of the range and moved them up from 50 basis points to 200 basis points, meaning that somebody could earn 200 basis points after inflation by giving the government money for 2 years. And what we experienced after that kind of flip-flopping in December with the famous kind of Christmas Eve flip-flop, those have kind of collapsed down to 55 basis points. So I guess what you're saying is that we're back into the range and that's not going up there again. Would that be correct?
Yeah, I think that's fair for at least for a while.
Okay.
All right.
So now, what does this mean for the S&P? Because if we have negative real rates for a while, what are you thinking it means for stocks?
So yeah, interestingly, we're about to challenge the all-time high. So we're about to hit that October where we fell apart in October from far from neutral, as well as like kind of the top of the channel we've been in since 2009. So two significant technical levels that we're about to hit right as rates start to pop a little bit. And if you remember in October, kind of the rate of change of interest rates started getting ugly. Like they started really accelerating higher. We started getting the technical breakouts that everyone was talking about, and a lot of people started getting bearish bonds, not the people that had been for a couple of years. And that's kind of when stocks fell out of bed. So now we're right back about there, and rates are accelerating again. So that rate of change on interest rates could start becoming a problem for the S&P, not to mention further rolling over on data. So I think you're finally getting to a level that looks like you could put on a reasonable short in the S&P and actually have an expectation of doing well.
Nice. That's what I like to hear.
So you're bearish. So you don't think we're about to explode to new highs? And if we do, it's just a chance to sell more.
Well, if we explode to new highs, I'm not sure I'd sell more. But if rates kept going higher too, then I would I would look for it to break. But I'm definitely not into shorting new all-time highs. That's for sure. But okay. I just think as we test the previous high, there's a good chance
there's
that
asymmetry there because it's either going to fail there or not, right? And so I like the way he thinks there, Kev. He's onto something.
You know what? He talks about fundamentals and then shows me a lot of squiggles.
Yeah, I'm definitely a squiggle guy too. So,
all right,
that's good. The best of both worlds. You're like both of us put together in a much better fashion. Okay, well, thanks for all that.
One.
That's right.
All right, let's move on.